Among hundreds of dividend ETFs out there, is SCHD ETF the best one? Well, from the comments section and also a quick search on the internet, that seems like a huge yes, but is that really the case? I mean, historical dividend yield of more than 3.5% on top of a solid 10+% of capital gains every single year. This is literally the dream dividend machine for most investors. But people say when things are too good to be true, might just be. So my mission today is to take a deep dive into this dividend ETF to explore everything you need to know, from its expense ratio, performance, valuation, dividend sustainability, comparison with S&P 500 ETF, etc, so that you can make a better informed investment decision rather than just blindly buying into all the hype out there. I also leave a link down below for you to check out its latest fun fact sheet and other sources just in case you need it. And without further ado, let's start with an overview of the ETF. Now, the SCHD ETF, or the ticker symbol for the Schwab US Dividend Equity ETF, is a fund that tracks the Dow Jones U.S. Dividend 100 Index, basically 100 of the largest US companies with a record of consistently paying high dividends and also a strong financial track record. Their top 10 holdings include companies like Amgen, which is a huge biotech company that is known for creating medicines that treats cancer and arthritis. AbbVie, a biopharma company that creates medicines and drugs for various diseases. Chevron, the second largest oil and gas player by revenue in the US. PepsiCo, you should know what Pepsi does. Merck & Co, also a huge healthcare company that manufactures medicines and also vaccines for both human and animals. Pfizer, the company that is well known for many medicines, and I'm sure you know, including the COVID-19 vaccine. Coca-Cola, you should know also, the company famous for the Coca-Cola drink as well as a bunch of other drinks like Sprite and also Fanta. Broadcom, a huge semiconductor company that manufactures lots of parts for smartphones, computers and also networks. Verizon, they are basically one of the largest telco company in US. And also lastly, Texas Instruments, also one of the largest semiconductor manufacturer in the world. So if you notice a trend over here, the companies that I've just mentioned are all huge companies that manufacture and also ship essential products that we all need on a day-to-day basis, like medicines, semiconductors, oil and gas, beverages, etc. And so that is why they are strong candidates for a dividend ETF like this, because they are so well established and their importance in the international economy cannot be understated. And hence why a more mature business model usually translates to a lot of free cash flow, and that means they can distribute more dividends periodically to their shareholders like you and I. And it's good to know that pension funds in the US often invest a lot of money in these big companies because the periodic dividends that these companies give to their shareholders from their profits help fund the retirement of many people in the US. So these companies usually try not to stop these payments unless something really bad happens to the economy, like the pandemic in 2020, because it could affect a lot of retirees' income. Anyways, let's look at its numbers. It has a 30 days dividend yield of around 3.8% per annum, but on average you can expect about 3.5% per annum based on its historical data. And this is on top of their strong annualized returns of around 10.5% for the past 1 year, 12.3% for the past 3 years, 9.6% for the past 5 years, and about 11.1% for the past 10 years. So on average, based on quick and dirty math, you can expect to grow your money somewhere around 13 to 15% per annum before tax, because tax can be a real pain in the butt for dividend paying ETFs like this one, especially for most of us non-US residents. I'm gonna sound like a broken record here, but if you come from a country that does not have a tax treaty with the US, like Malaysia and also Singapore, then the dividends paid will be taxed at a flat rate of 30%. So essentially that 3.5% per annum dividend will be taxed, and you will only be getting about 2.5% after you minus off 30%. And this is actually a huge factor that you as an investor need to consider, because this withholding tax will compound over a long run since you are gonna leave it for long-term investments, right? Not that it's the end of the world, but this is just a timely reminder that just because most US content creators or finance websites highly praise this ETF, you need to remember that they are paying significantly lesser income tax, hence why we are at a huge disadvantage compared to them. So do take note on that. And in case you want to learn more, there are of course alternatives to SCHD ETF that are more tax efficient. Click here to learn more about island domiciled dividend ETFs. Now, we have seen its impressive dividend yield history, but what's more important is looking at these companies' ability to pay dividends into the future, because we don't drive looking at the rearview mirror, right? And remember, a company paying a dividend is actually extracting out a portion of their free cash flow, and in some cases, companies will just overdo to please their shareholders, and that might not be a healthy thing for their financials. So to do that, we're gonna look at 3 different metrics in their 5-year average: dividend yield, free cash flow payout ratio, and also dividend coverage ratio. The dividend yield tells us how much dividends the top 10 companies are paying compared to its share price, and on average they stand at around 5.24% for the top 10 companies. That's very high compared to a lot of other companies, but it's not unusual for companies with mature business models like them. And in terms of their free cash flow payout ratio, it tells us how much dividends the companies are paying from its free cash flow. It's like asking if a friend who owes you dinner can really afford it without breaking their bank. So a healthy ratio like the 47% average we see over here means the companies aren't stretching their wallets too thin and can likely keep paying you that dividend without financial strain. And the third metric, the dividend coverage ratio, tells us how many times a company can pay dividends to its shareholders using their net income. Generally, 1.5 is considered to be a good ratio for a comfortable margin of safety, and anything above 2.0 is considered not so sustainable. So as you can see here, the top 10 companies here average about 1.96, and that's also another sign that some companies here could be reducing their dividend payouts in the future. But the numbers itself can't really tell the full picture, because we also need to consider the industry factor here. For example, consumer staple companies like Coca-Cola and also PepsiCo can sustain higher payout ratios thanks to their stable cash flows. And remember, these are just 10 of the 100 companies in the ETF, so we need to look more into the other members of the ETF to make a better conclusion. Quick pause before we continue. If you are looking to invest in this ETF, then look no further, because Interactive Brokers is the best option for you out there. It is highly regulated and licensed in over 10 different countries. Plus, their commission fee for trading US ETF like this one is one of the lowest in the industry, only 35 US cents for each trade. I personally have been a user of their platform for more than 4 years now, and happy to report that my account opening, funding and also investing experience has been very smooth and fast. Check out the link in the description box down below and get your account open within a day or two. Okay, let's get back to the video. Anyways, as I was just saying, we can't just conclude how SCHD performed as good or bad, because a smart investor always weighs all the possible alternatives. And so let's compare it with my preferred S&P 500 ETF, the VOO ETF by Vanguard. And in terms of their total return for the past 10 years, which means their dividend yield plus capital gains, you can see that both of them are actually very comparable, with the S&P 500 return coming out on top by a considerable margin. And what makes it contrast even further is that SCHD has an expense ratio of 0.06% as compared to the VOO at 0.03%, double of that. But anything below than 0.1% to me is actually still pretty low. But looking at the returns alone won't tell you the full story, because remember, SCHD and VOO have two different risk profiles, as the VOO have higher weightage on high growth tech companies that don't really pay dividends, as they are still reinvesting their profits aggressively. And you will see it from their standard deviation, which basically tells you the range of an ETF's performance. The higher the SD is, the greater the potential for volatility. So with the higher SD by VOO, it only makes sense to come with a higher return. And in terms of Sharpe ratio, ratio, which tells you the ratio of their risk-adjusted return, which basically means what's the actual return you are getting for your investment after taking into account the risk you are taking with it. So the higher, of course, it will be better. So you can see that they are actually pretty neck and neck, with the VOO coming out on top in all three different time horizons. So yes, in general, VOO does have better overall performance plus lower expense ratio, but like I've said earlier, that comes at a cost of greater volatility. So all said and done, here are some of my thoughts on investing in SCHD ETF. Firstly, dividend investing, especially from a non-US resident's perspective, is not tax efficient. There is basically double taxation in place. One, when the US companies pay dividends, and two, when the US ETF pays you dividends. That's two layers of tax. It's definitely slightly inferior to growth investing, like with the S&P 500. But that said, I do see many dividend investors will look past that and still enjoy the strong and also consistent dividend payouts from this ETF. And number two, the US Federal Reserve is expected to start cutting interest rates in 2024, and usually that would also mean a better valuation for dividend paying stocks, because that will also lower the cost of borrowing for many companies, and in turn better profits, which means better free cash flow to distribute higher dividends to all of us. And the same goes the other way around. Depending on when you are watching this, a rising interest rate can negatively impact this ETF, so do take note on that. And number three, portfolio diversification wise, if you already have exposure to the US companies, most likely in the growth sector like technology, then having some sector diversification towards industrials, healthcare, financials, and also consumer staples could be a good idea to lower the volatility or beta of your investment portfolio. Companies in these sectors usually have a stronger pricing power, and so they can better pass through any inflation costs onto consumers without losing sales, protecting their profit margins and also their ability to pay consistent dividends. My point is, SCHD might not be the one-size-fits-all solution to investing, but it could be a valuable part of your portfolio if you are working towards retirement, or you're just looking for a consistent income rather than risking it with growth stocks over a very long term. Then that's very viable. Alright, I hope you enjoyed this ETF deep dive. Do let me know in the comments down below if you have any questions or you have any other ETF that you want me to cover. I can't wait to hear from all of your feedback. Until then, if you're still unsure which ETF is the best for you, check out this video where I've summarized the top ETFs every first-time investor should start looking at. See you over there.